Hi, Marlene.
Hi, how are you?
Welcome aboard. Hey, I'll be right back, guys. All right, everybody, sorry for the delay. Welcome back. I guess today we're on to chapter 2, which I will go through and entertain questions or comments or suggestions. So give me a moment here to bring up the appropriate file. Give me a second here. Come on. Hey, Thomas, can you tell me one way or the other whether you can see the screen now? Or Daniel, maybe Thomas can't talk.
Yeah, I can see it.
Okay, there we go. Thank you very much, Daniel. Here we go. Accounting transactions. Hold on a second. I got the wrong file. Hold on a second. Oh, shoot. Hold on. I got the wrong thing here. Off to a rocky start here. Modules, chapter 2. Chapter 2 is where we should be. We want it in PowerPoint mode. Okay. Stop share. Share. Okay, we can see it now, Daniel?
Yeah.
Okay, here we go. Chapter 2, financial accounting tools for business decision-making. Look at financial statements. We're going to talk about a balance sheet and an income statement and different sections of it. We talk about a few ratios that all customers, not all that all investors use, employees use, management uses, and some reporting concepts. A classified balance sheet. If you took 110, you might remember that a classified balance sheet is one that separates the current assets from the long-term assets. The current assets are summarized, and then come the long-term assets. So if you're looking at a balance sheet that's classified, and virtually all of them are, you're going to have a subtotal for current assets, a subtotal for fixed assets, also known as long-term assets, for plant property and equipment, and intangible assets. On the other side, where you have current assets, you have current liabilities, long-term liabilities, and equity. Liabilities mean a debt. Liabilities means money we owe to somebody. And we can just take a peek at it here. Here is a look at the slide in a bigger format here. Current assets are listed first. Subtotal. Long-term assets, which they're calling investments in stock, investment in a bond, investment in real estate. Then what are really called fixed assets. Property, plant, and equipment are better known as fixed assets. And you notice that they are depreciated, which we're going to get into. And then you have intangible assets. Intangible assets are those that you can't see. You can't feel them. You can't point to it and say, there it is, but it is certainly there. Patents is a good example of an intangible asset. A patent means that you invented a product, you secured a patent number from the United States Congress, and that gives you the right to market that product to the exclusion of everybody else. That's an important intangible asset. A copyright, that gives you permission to publish your own book for a certain amount of years, even after your death. Trademarks are an intangible asset, like the McDonald's logo, for example. So we have intangible assets. We add our assets up, and we have $61,400, huh? $61,400. Take a peek here. Here is the classified balance sheet for the liabilities and stockholders' equity section. Note, please, they're starting these things with notes payable. Typically, accounts payable goes first, but that's okay. We start with notes payable, accounts payable, unearned revenues, salaries and wages payable, interest payable. Could be a lot of different types of payables up there. The point is, the current liabilities are isolated into its own category. Here are the long term. The long term, they might have a 30-year mortgage on a building or something. They have notes payable repeated, but these are notes that are more than 30 days. A current asset is an asset that's going to be used up within a year. A current asset is an asset to be used up within the current year. A current liability is a liability that will be paid within a year, okay? So that's the difference between a current asset and others, 1 year. So we see the current liabilities laid out. We see the total liabilities. And then we have the stockholders' equity section, which consists of common stock and retained earnings. Total liabilities and stockholders' equity. Notice that number, 61,400. Here it is again, your accounting equation. Assets equal liabilities plus equity. That's the basic accounting equation that I think we're going to be hitting hard in our next class after the holiday. So a balance sheet, assets equal liabilities plus stockholders' equity. And this is a snapshot in time. Auditors are going to come into your company and they're going to say, how much cash do you have on hand? How much cash you got? And you tell them we have $6,600,000,000. And they'll say, show that to me in your general ledger. You bring up your general ledger, and there it is, 6,600,000. That's just the start of their journey. They're going to dig into those details. They're going to verify that this cash is real, that you really do have these bank accounts, that you really do have these short-term investments that you're rolling into cash. That's how they're going to start their audit. They're always going to begin from the outside in with the general ledger. Current assets, the company expects to convert within 1 year, cash, short-term investments, receivables for the most part, inventories, prepaid. For purposes of this course, these are pretty much your current assets: cash, investments, receivables, inventories, prepaid expense. What's an investment? That means that we bought stock of another company. Coca-Cola is a company that I'm always telling you I own stock in Coca-Cola. The ownership of Coca-Cola can go out and buy 100 shares of Microsoft if they want. That would be a Coca-Cola investment in Microsoft. And the operating cycle is typically the average time it takes to purchase your inventory and collect the cash. But we're going to work with that 1 year constraint. 1 year, current assets, current liabilities. And again, they're showing you the presentation. I don't know if these are the same numbers as before, but no, they're different numbers, but that's okay. They're showing us Southwest Airlines. Now, these are actual numbers for Southwest Airlines. Notice that this thing is in millions. So that number there, 1680, you got to put 6 zeros after it. They have $1,680,000,000 in cash. They have $1,625,000,000 invested in short-term investments. Accounts receivable, that's 546 million. That number represents how much their customers owe them at that point in time. And then they've got inventory. They would have a lot of inventory, wouldn't they? They would have a lot of parts around to fix the planes. They would have a lot of paint, all kinds of things. And then prepaid expenses like insurance or supplies. One other point, your current assets and your current liabilities are listed in order of what's called liquidity. In other words, liquidity means cash. They're listed in order they expect to convert them to cash. Cash is cash. You can't get any more liquid than that. Short-term investments are very liquid. You can sell them in a split second by calling your stockbroker or doing the trade yourself online. Accounts receivable, that's liquid, but not quite as fast as the other two. Inventories, etc. Liquidity, keep that number, that term in your mind. Cash and other resources that are reasonably expected to be realized in cash or sold or consumed within 1 year. We just decided that's a current asset, huh? Current asset. Intangible assets, long-term assets, and fixed assets, they can go on forever. Components of long-term investments. Investments in stocks or bonds that are held for more than a year. You, for example, buy a bunch of shares. What, could you hold on, please? Hiya. You okay? I thought I was being interrupted by my boss. I hope she's okay. Components of long-term investment. Investment in stocks and bonds of other corporations. You hold them for more than a year. It's a long-term investment. Land, building, equipment. That's certainly long-term investment. And a note receivable. You might have loaned money to somebody and they owe you money, but the money's not due for 5, 10 years, long-term. And your long-term presentation on the balance sheet will be just that. You're going to have long-term investments. I'd like to see a colon after the S in investments, non-marketable investments. Nature of property, plant, and equipment. These are assets with what they call useful lives. And useful life is an accounting term that has a certain meaning. When you buy an asset, you're allowed to estimate its useful life. And using that useful life, you will allocate year by year the expense of that equipment. So it's an asset with long useful life and you're using it. It includes land, buildings, equipment, delivery, and furniture. They're depreciated, meaning the cost is going to be allocated to a number of years using different methods of depreciation, which we'll learn. One thing that's not correct here is land. You see where it says includes land? Land is not depreciated. Land is not depreciated. So you're going to buy an asset for $1 million, and then you're going to depreciate it for $10,000 each month. That $10,000 is going to create an account called accumulated depreciation. Total amount of depreciation expense to date. It's a contra asset, which we'll get into. So let's take a good look at the section for property, plant, and equipment. We have the heading there, property, plant, equipment, land and land improvements, buildings, machinery and equipment. Wow, look at all that stuff they have. That's, you gotta add 6 zeros to that again. So that would be, that can't be 1 trillion, is it? No, it's gotta be 1 billion. 1,742,449,000 worth of equipment. Hold on 1 second. I want to write that down. 1,742. Oh, this is in thousands, not millions. Okay, yeah, that's 1 billion. Okay. So 1 billion. But the point I want to make is you have the original cost of the asset, the 47,767, the buildings, 22, machine, the molds and cores. You add those up, that comes to $2,097,000, excuse me, $838. We are going to depreciate this equipment, and thus far, this company, Cooper Tire and Rubber, has depreciated $1,433,000 of that $2,297,000, meaning that the net property, plant, and equipment is the $864. You subtract that out. Let's talk just a little bit about intangible assets, goodwill, patents, copyrights, trademarks, trade names. Goodwill, that's simply the amount you paid for a company that's more than its real value. You want to buy my company, the Bob Smagula company, and my company you figure out is worth $1 million. You offer me $1 million and I say no sale. I'm not selling for $1 million. I want $1.5 million. And we negotiate and you give me $1.3 million. You just gave me $1.3 million for a company that you know is only worth $1 million. That $300,000 difference has to go somewhere on your balance sheet, right? And that's called goodwill. Goodwill. Why would you pay $300,000 more than my company is actually worth right now? Well, because you say to yourself, Bob has customers that I've been dying to get my hands on. If I can get to his customer base, I can triple my sales and really get some synergy out of Bob's company. And let's take a look at the amortizations here. Again, we're in millions. So that's the B word for franchise intangibles. Boy, Disney has a lot of different things going, I bet, huh? Franchises they have other amortizable, if I can say that word correctly, amortizable. Federal Communications Commission licenses, trademarks, a lot of trademarks with Disney, $1 billion worth. And then some other things with an indefinite life and goodwill. Disney has gone out and bought other companies for more than those companies were worth, thinking they could do better than them. Patents and copyrights are classic intangible assets. Intangible assets. And they're showing you the assets section of Baxter Hoffman. They're mixing up the numbers, okay? They're mixing up the numbers. So why don't we let's take a peek here. We just learned what comes first, our current assets, correct? Current assets come first. So we know we're going to start with the current assets. And we also learned they get listed in order of liquidity, which means ability to convert to cash. Well, let's see what we have here. We've got cash, $800. That's certainly our first one. Accounts receivable is probably next, 1,100. Then I see prepaid insurance and inventory. They could probably go 1, 2. So I think we're looking at cash, receivables, prepaid insurance, and inventory. That's 800, 10, 7. There we go. Current assets we pulled from here. Next, we're going to layer in the long-term investments. The long-term investments. And that's what we have right here, the debt instruments, the debt investments, then the fixed assets, the equipment, $10,700. It's been depreciated $2,700. I don't see any other fixed assets there. So we've gone through here. 10,700 minus the $2,700 worth of accumulated depreciation. Accumulated depreciation means that the net book value is in this case, $8 billion, okay? What else do they want us to do? Well, we got to figure out what else is up there. Looks like we have some intangibles. We took care of the prepaid insurance, the inventory, cash, equipment. I see trademarks. Those have to go on there as other assets or intangible assets. And there you go. There's the balance sheet section for assets. For assets. Yeah, they just wanted to do the asset section. So when you're doing your homework, you know, look at have this grid in front of you. A lot of your homework, excuse me, is going to be along the lines of putting these statements together from paragraph type information. Excuse me. Oh, that's good whiskey. Okay, here we go. Let's talk about current liabilities. Obligations the company has to pay within the next year operating cycle. For our purposes, it's 1 year. Accounts payable, salaries and wages payable, notes payable, interest payable, income tax payable. It could be a lot of others. When you see the word payable, it means that person owes money to somebody. Payable. Accounts payable represents the money we owe to our normal suppliers, to the electric company, to the insurance company, to the guy we buy our merchandise from. Accounts payable. Accounts receivable is the same thing, except we're on the receiving side now. Accounts receivable. Money's owed to me, that's accounts receivable. To you, it's accounts payable if you owe me. And here they're just showing you the balance sheet section, including current liabilities. And they're simply itemized just like that. You're always going to start with accounts payable, then short-term, and then the accruals. We're going to learn a lot about accrual journal entries as we go along here. Whenever you see the word accrued or accrual, you know it's a short-term. You know it's a current liability. Income taxes, by definition, are always current. It's not often the federal government says, okay, all right there, Daniel, you can pay your 2022 taxes in 2025. It's not going to work that way. Nature of long-term liabilities. Obligation a company has to pay within a year. Bonds payable, mortgage payable, notes payable, leases, that could be a big one. Pension liabilities, huh? Pension. I'm collecting a pension from my former company right now. And they owe me that money, and that's built into that liability. Mortgage payable, that's the long-term portion of a mortgage. Hopefully you'll all be out in the housing market one of these days in the not too distant future, and you buy a house, and you're probably going to take a 30-year mortgage on it. 1 year of that mortgage is considered current. The remaining 29 years are always long-term. Long-term notes payable means a borrowing situation longer than a year. And lease, boy, companies do a lot of leasing. Long-term liability, here's Nike. Bonds payable, holy cow. This is money that Nike owes right now. That's $5,474,000,000, huh? That's a pretty good chunk of money. $5,474,000,000. Plus they owe a ton of income taxes. But Nike is a big company. I'm pretty sure they're profitable. We all use their equipment or apparel at one time or another. And I think they can handle this kind of debt. Which of the following is not long-term? Well, bonds payable can be long-term or short-term. I see the word current, so I'm thinking the answer is probably going to be B. Long-term notes payable, mortgage payable, bonds payable. Just remember, bonds and mortgages can be both short-term and long-term. The same bond can be short-term, long-term. Whichever due within the next year, short-term. Otherwise, we got long-term going. Let's look at the stockholders' equity section. We've gone through the assets. Now we're looking at stockholders' equity. This is what the company is worth on paper. It typically has nothing to do with what the company is really worth in the marketplace. And that's because you can never increase the value of your assets when they go up. Only when you sell them can you show a profit. So you might be holding some assets that are currently worth millions, but you only paid thousands for them. But suffice to say, assets equal liabilities plus equity. And here we're talking about common stock and retained earnings. And we're going to see this a lot. Common stock, retained earnings. Common stock. You went out and you solicited money. I think it was Twitter or Facebook about 15 years ago had an IPO, an initial public offering. And in that public offering, they announced to the world, we're selling 1 billion shares of our stock, $1 par value. And what happened was the stock brought in, I think, $30 a share. So they made $30 billion that first day. Zuckerberg expected to do $50, but then got 30. But he was still not poor with the 30 billion. Common stock, you've sold stock to the public, and they've provided the funding for you. Retained earnings, income retained for use in the business. You start a business today. And you have no retained earnings by definition because you haven't done anything. After the first year of business or the first month, you close out and you find out you made a profit of $100,000. Your equity has now gone up $100,000 and it's recorded in the equity account called retained earnings. Both of these are equity accounts. The next year, you made another 400,000. Now your retained earnings has gone up. You get the idea? The retained earnings account will represent your income and losses netted out over the entire history of the company. The only thing that is going to reduce your retained earnings will be if you choose to pay dividends. Then that will reduce retained earnings. Match each of the account names on the next slide. Okay, let's take a peek at this. Match each of the account names on the next slide to its proper balance sheet class. If the item would not appear on the balance sheet, use NA. Well, let's see what we got here. Current assets. All right, we'll start with salaries and wages payable. These are our choices. Current liabilities, long-term liabilities, stockholders' equity, current assets. So what do you think? What's the first one? Salaries and wages. What do you think that one would be? That's a classic current liability. Classic current liability. You invested in real estate. I'm guessing that's a long-term investment. Unearned service revenue. I'm not sure this is fair to ask this one yet. This is a situation where you get paid in advance, excuse me, for work that you haven't done yet. And this would be a current liability. Debt instruments. Debt instrument. Here, or debt investment. I read that as instrument. Debt investment. Short term. We know that's a current asset. Mortgage payable due in 3 years. Long-term liability. And accumulated depreciation is part of a fixed asset. I just want to see one thing here. That's part of your property, plant, and equipment. Okay. Match each account to its proper. I think we just did this, right? Oh. I'm sorry. Match each account to its proper balance sheet classification. If the item, oh, they're just continuing this project, okay. Service revenue, that does not go on a balance sheet, huh? That would be on your income statement. Same thing with interest payable, that would be on the balance sheet. Try to keep in mind as we get familiar with some of these concepts, the income statement can be simply summarized as revenues minus expenses. Revenues and expenses, that's all you're ever going to see on your income statement. The assets, the payables, and the equity go on your balance sheet. So interest payable would be on the balance sheet. So would goodwill. I see the word expense, depreciation expense, so we know that's not on the balance sheet. Retained earnings and equipment would be, of course. Retained earnings, equipment, okay? All right, that's a look at the setup on a balance sheet. Hopefully when you do the chapter 2 problems, will keep getting clearer and clearer. Use ratios to evaluate a company's profitability, liquidity, and solvency. Ratios. Companies use these all the time. We do it in our own world almost every day when we're shopping. Should we buy a 6-pack of Coke, or should we buy the 64-ounce liter bottle? What do? Analyzing financial statements using ratios. Ratio expresses the relationship among selected items of the financial data. A ratio means you're dividing something. Something's being divided by something. It expresses the mathematical ratio between one quantity and another. A single ratio by itself may not be very meaningful. So let's see what they're talking about. We're going to have profitability ratios. Measure the income or operating success of the company over a period of time. Liquidity ratios. Liquidity ratios means that the company is trying to figure out if they have enough money to pay its maturing obligations and its current cash needs. And solvency discusses the long-term survivability of the company. So let's take a look at Best Buy. I like Best Buy. I've gotten good service from them. Best Buy. Well, again, this thing is in millions. So they had sales last year of $39 billion, 39B with a B. Cost of goods sold is a big expense. Cost of goods sold is an expense that represents what you paid for the item you sold. In other words, Best Buy sold $39 billion worth of computers, but it cost them $29 billion to make them or purchase them themselves. So our income statement, as we know, is simply going to be revenues minus expenses equals the net income, hopefully, and not a net loss. Nature of earnings per share, huh? I bet you've heard this expression before, earnings per share. Investors are always looking at it. You know, I'm an investor. I own, 3 or 4 stocks. I'm always wondering what the earnings per share is at the end of a particular month. It's a profitability ratio. It measures the net income on each share of outstanding common stock, often called the EPS. All we're going to do is take the net income of the company and divide it by each share of the common stock. So let's see what we have here. We have net income of 1,228,000, and the outstanding shares at the beginning of the year were 324, and at the end were 311. So we must turn that into one number. So that'd be 324 plus 311, that's 635. So the difference is like $117 million shares, okay? Keep in mind, and this is easy to forget, that we have to reduce the net income for any preferred income, okay? So let's work with this now. We have 1,228,000 divided by the average of 324 and 311. We get $3.87 per share. $3.87 per share. So if you think you want to invest in Best Buy, you can say to yourself, For every dollar that my buddies around the world have invested, they're making almost $4 per share. So that could be a good number, it could be a bad number. It could be a bad number depending on expectations. The stock market does not like to be surprised. Suppose Best Buy was saying all year, we're going to have a great year. We're going to come up with an EPS of 4 or better. If they came up with 3.87, they would be short a little bit, but it would be enough to jolt the market because the market just reacts immediately to these misses. Look how big a profit it was over the year before, $2.65. Now, why was that? Well, 2 reasons. They had fewer shares outstanding. They might have bought back some of their shares. And the income went up tremendously, went up by about 40%, it looks like. So there is one of your ratios, earnings per share. Stoneland reported net income, 26,000. Net sales were 400. And the weighted average they're giving you 6,000. So we don't even have to divide it. What were the preferred stock dividends? 2,000. We must subtract that from the 26. The net income minus preferred stock dividends gives us the income we're going to use for the ratio. So 26,000 minus 2 is 24,000. If there's a God in heaven, the answer is A. You see how we put that together? Total income minus preferred dividends, then we divide out by the total outstanding average common shares. The reason we subtract out the dividends for the preferred is that those are pretty much guaranteed numbers. And when we're talking the stock market, we're 99% of the time talking common shares. Preferred stock is a totally different type of investment than common stock. It has nothing to do with the earnings per share. Let me just say this. If you're interested in a company and they invented a cure for baldness, right? Then the common stock would start to go up, but the preferred stock would go nowhere because the only thing the preferred stock does is provide you a baseline dividend. Classified balance sheet. We're back to the classified balance sheet. Best Buy again. There's their cash number. And here they're comparing a full year, huh? Is it a full year or a full month? I guess it's a full year. Yeah. The end of their fiscal year was January 30th and the 16th. And I guess the 28th was a Sunday or something. So there we go. Total assets, 3,856, 13,5,919. Not too much of a difference. Wow, look at this. Current liabilities, they owe $4,984,000. And then you have your normal things, accrued liabilities, accrued taxes, accrued payables for wages, whatever. You notice that one that's called unredeemed gift card liabilities? That's a new requirement in accounting. I believe in chapter 1, we talked a little bit about GAAP, generally accepted accounting principles, and how the FASB make up rules as things change. It used to be that when a gift card was sold to Walmart, or in this case, Best Buy, they would consider that income. They would consider that income, which you're really not supposed to do because you haven't sold your product yet. But they knew that everybody doesn't use the cards. They know some people just accidentally get rid of them or forget about them. So now they're obliged to estimate a number for unredeemed cards and show it at least as a liability, okay? They don't owe money, they owe the service. Liquidity, the ability to pay obligations to become due within the next year. Here, this is our test of what's called working capital. Working capital. One of the first things an investor would look at is your working capital, which is calculated as current assets minus current liabilities. So Best Buy had working capital of 3,394,000, huh? 3,394. 10.516 million minus 7.122 equals 3,394. Working capital. And what that means is if they paid off all of their current liabilities right now, they'd have 3,394,000 left over. But when you talk in dollars, that's maybe not the best way to express it, because you can't compare companies of different sizes that way. So we want to start talking in terms of these various calculations, these ratios. So we're going to talk about something called the current ratio, and you'll be working with this one forever, huh? Current ratio. Current assets divided by current liabilities, okay? Now here they're using the same number. It's a lot clearer for anybody to look at this company and say their current ratio is 1.48 to 1. What that means is for every dollar of debt that they have 48 cents left over. So that's good to know. It's good to know that in the prior year it was 1.43, and then and 2 years before, or this is a different company, 1.51. So 1.51 is better. Suppose the ratio was 2 to 1. That would mean that for every dollar you pay off in current debt, you have another dollar left over. What if the ratio was 3 to 1? Would that be better still? Probably, huh? What if it was 4 to 1 or 5 to 1? That would be better, I guess. What if I told you it was 20 to 1? Would that necessarily be a good thing? Anybody have any thoughts on that? If you have a gigantic current ratio of, say, 25 to 1, why is that possibly a bad thing, especially today? No takers? Well, the reason might be if you're hoarding cash, you could be missing out on great investment opportunities. Why are you holding on to billions and billions of dollars in cash when interest rates are so low? If you put that money in the bank, you only get 1%. So if you have so much cash that you're choking on it, that could be real bad. That could mean you're missing a lot of good investing opportunities. That's all. And one of the problems we've had in the economy coming out when George Bush ended his presidency was companies were hoarding cash. They were hoarding cash because they didn't know which way the economy was going to go. Even now with the pandemic, companies are still hoarding, just not like before. So that was a liquidity measure. Let's talk about solvency, the ability to pay interest as it comes due and repay the balance of a debt. Now we're talking about repaying a debt, maybe long term. Measures the ability of the company to survive over a long time. Some users evaluate solvency using a ratio of liabilities divided by equity. The higher this debt to equity, the lower is the company's solvency. Let's say how they want us to do it. Take your total liabilities, divide them by your total assets. And here we're looking at three numbers that are pretty much the same, 66, 68, 69%. The 17 ratio means that for every dollar of assets that was financed by 66 cents of debt. So this company took on what would seem to be a lot of debt, huh? 66 cents. They borrowed of their monies, they borrowed 66 cents for every dollar they've got floating around there. That could be good, it could be bad. It depends on the situation, it depends on the industry, it depends on the economy, your expectations. And this, I think, is a little bit interesting. Debt financing differs greatly across industries. Here are some debt to asset ratios for selected companies in a given year. Google, they don't seem to have that much in debt to asset ratio. But when you get into more industrialized companies like Exxon, General Motors, These are companies that are heavily involved with big equipment. They're buying tons and tons and tons of steel and glass and rubber. Looks like they have to borrow to get through their manufacturing season. So General Motors is very capable and very happy with 74% financing, and they survive. Google could not do that. Let's talk about cash flows. Cash flows, free cash flow. In the statement of cash flows, cash provided by operating activities, and it's in the statement of cash flows, it doesn't take into account that a company must buy new property, plant, equipment. They must maintain dividends at current levels. Companies don't have to pay dividends. Coca-Cola never has to pay me my 3.5% dividend, but I'm counting on them to do so, as are millions of other people, because Coca-Cola has never failed to pay a dividend in its entire history. And there's no reason to think they would now start not doing it now. So Coca-Cola needs to make sure they always have enough money for dividends. And they also want to make sure they have enough money for big ticket spending. We need to open up that new bottling factory in Asia, or that new assembly line in Georgia. We need to set money aside. Free cash flow. Follow me now. Free cash flow. Net cash provided by operating activities. Net cash provided by operating. That's what our operation has provided us. We got to subtract from that capital expenditures, which are the big ticket items. Capital spending means fixed assets, minus cash dividends. Free cash flow, whatever we generated operationally, minus capital expenditures, minus cash dividends. And let's see what we have here. MPC produced and sold 10,000 personal computers. It reported $10,000, $100,000 in cash by operating. In order to maintain production, they're going to need $15,000 in equipment, and it may choose to pay $5,000 in dividends. So you have to subtract those two numbers out. Cash provided by activities, less the 15, less the dividends you're going to pay, $80,000. Okay. These types of questions you get on the test. Wow, look at all this stuff for Ozone Company, whoever the heck they are. Yeah, they're giving us total assets and liabilities. They're giving us all kinds of stuff, huh? Assets, liabilities, income, cash provided by operating activities. We don't have to figure that out. Preferred dividend, and then the beginning and ending shares. So using this information, we can compute some of these ratios we're interested in. Earnings per share. They had earnings per share of $2.20 in 2002. And I guess they're going to show us earnings per share. What were the earnings? The earnings were $100,000 per share. Earnings per share. That would have been an average of what, 90? Minus 10. You see what I forgot to do? I fell into that trap. I forgot to subtract the preferred dividends. That's a very easy mistake to make. So let's start again. $100,000 net income minus any preferred dividends gives us the basis. We're going to divide that number by the average shares, which would be 180 divided by 2, or $90,000. There we go. In 2022, it was $1. In 2021, it was 80 cents. Okay. Income, 100,000 minus any preferred dividends divided by the average outstanding shares. Debt to assets ratio, working with the same numbers. This is going to be total liabilities divided by total assets, I believe. So I'm seeing 120 over 88. Is that right? 88. 88 over 40. There we go. Current, the first thing they did was give us the current ratio. They didn't tell me that that was going to be part of the question. They did the current ratio, 88 over 40. Current ratio, 88,000 divided by 40. Then they did debt to equity. Debt to equity, total liabilities 120 over 88. Okay. So take a look. Question, anybody? No, okay. Thought I saw a hand raised. Hang in there with me. We're getting towards the end here.
I did have a question for you.
Go for it.
What happens if a company does not pay the dividend to its stockholders?
What companies, say it again, Brian, Daniel?
What happens if a company does not pay the dividends to a stockholder?
It would depend on the company. There are certain companies where you don't want them to give you a dividend, believe it or not. A startup company, for example, a company like Microsoft, when it first began, they could have paid out big dividends, but they did not do that. And the shareholders said, we don't want dividends. What we want you to take is every dollar and plow it back into the company and grow the value with a stock. We'll worry about dividends later on when we're old men, okay? But a company like Coca-Cola, if Coca-Cola announced today that it was suspending its dividend, that would be front page news. And Coca-Cola stock would take a beating. I would lose a lot of money. So it depends on the situation. Startup companies, your technical companies, they typically don't pay dividends at all. But the money is made on the increase in the per share value of the stock. Make a little sense, Daniel?
Yes.
Good question. Free cash flow. Remember, this is the operating cash flow minus money we set aside for capital spending and dividends. Here's our net cash. They provided these numbers to us. Less expenditures for PPE. Okay. Free cash flow. That's $50,000 the company can do anything with. It's like you have an allowance. You know, when you were a kid, you were an allowance. You might have an allowance of $1, say $5 a week. I'm picking a number, $5. But your dad says, I'm not giving you 5, I'm giving you 4. I'm putting $1 away in a bucket for you. That would be an example of free cash flow. Discuss financial reporting concepts. Here's GAAP. You're going to hear this all the time. GAAP, generally accepted accounting principles. It's the set of rules promulgated by the FASB, the Financial Accounting Standards Board. These are the guys who make up the rules. The accounting profession recognizes them as the people to go to, determined by standard-setting bodies. Now, you can run a business and ignore GAAP rules. You can say, well, I'm not going to do it that way, or I'm going to do it my way. Yeah, you can do that, but you're never going to be able to grow the business. You're never going to be able to borrow money. No one will ever invest in your company until they see properly audited GAAP prepared financial statements. And these are the players involved. You've heard of the SEC, the Securities and Exchange Commission. They monitor the stock market. They monitor specifically the New York Stock Exchange, the biggest trading vehicle in the world. They set standards for how big a company has to be on it. They must have this much in sales, all kinds of rules. Then those companies must have prepared financial statements according to FASB and GAAP, and international and public are a little bit different. Generally accepted accounting principles. I like A, huh? a set of standards and rules that are recognized as the general guide. I'm not sure how much we want to look at this one. Qualities of useful information. Useful information is only useful if it's relevant and faithfully representative. In other words, accurate. FASB states useful information should possess two qualities: relevance and faithful representation. Suppose they came out with a note that said half of the employees cash their check at the bank and half the employees use direct deposit. Well, that's an interesting statistic, but it's not relevant to anything. It doesn't mean anything. What they want to report are the things that are relevant, important. Here's a word you're going to hear: materiality. Here's materiality. I worked for Thomas and Betts most of my career, right? The auditors would come in and they would say, Bob, what was the total on this project? What did you get? And I said, well, I figured that it was $1,250,000 profit. The auditor does their check and they come back to me. Bob, you were wrong. It was not $1,250,000. It was $1,244,000. You know what they would say? For $6,000, it doesn't make any difference. It's immaterial accounting wise. Now, if they came up with $1 million, that would be a different story. And they'd have to rewrite what I've done. Any item is material when its size makes it likely to influence the decision of an investor or creditor. I announced to the world we did $1,250,000. It turned out to be $1,245,000, say. Irrelevant. Relevance. Here, we're going to finish up with some of these terms. I'm not going to read these slides word for word, but make a note: relevance, faithful representation. These are low-hanging fruit for your test. They love to throw these on the test. What's a relevant cost? Well, it makes a difference. We can confirm it. It helps us predict the future, maybe. Faithful representation. It's complete and neutral, not biased toward one position or another. And then we got different ones: comparability, verifiability, understandability, consistency, timely. If companies are using the same accounting principles, they're comparable. If they're using the same principles from year to year, they're consistent. So that's a subtle difference between comparability and consistency. Information is verifiable if it can be independently observed, just like science, huh? If you prepare an experiment and expect something to happen, and it happens and happens and always happens, that's verifiable. The information needs to be timely. A company is having trouble paying its bills, and they get to the end of January, and there's such a mess that the accounting department couldn't even get them their financial statements for 2 months. Well, guess what? During those 2 months, the company went out of business. The information they were getting from accounting wasn't relevant because it was too late. Understandability. Boy, look at these things, huh? Monetary unit assumption. It assumes that we can measure the business in dollars or whatever your currency is. Economic entity assumption. This means that every economic entity can be separately identified and accounted for. We're not going to be mixing up Nike with Adidas or something. Going concern assumption. I love this one. The assumption is that the business will remain in operation in the future. If an auditor does their work and they get done and they find out that the company has really got not much of a future, they have to indicate that. They have to say that. Otherwise, you assume it's a going concern. Here's a word I've never used in conversation in my life: periodicity, if I'm saying that correctly. Periodicity. It states that the life of a business can be divided into artificial time periods. It just means you have a business and you are able to block out a period of time, typically a month, one period, and come up with some numbers that tell you how the business is doing. Here's a real important one. Historical cost dictates companies' record assets and cost, the cost principle. You bought a piece of land in Santa Barbara, your grandfather did, right after World War II. He bought 10 acres of land off Ledbetter Beach. And he paid $100,000 for that land. That land is still $100,000 on your financial statement. Today, that land is worth not 100,000, it's worth 10 million. But you have to keep recording it as 100,000. You cannot represent a gain or a loss until you sell the asset. Fair value, full disclosure. And here they're just listing the different accounting terms. These are all GAAP terms with specific accounting meaning. And I don't think we want to go through this in any great detail, but let's just whiz through. Match each item with the appropriate ability to easily evaluate one company's, I believe they called that comparability. Belief that the company will continue, what are we talking about? Going concern? The judgment whether an item is large enough. My favorite, materiality. That's the argument I'd always get into with the auditor. He'd catch my department in a flub, and I would go, oh, it's not material, let's ignore it. That's a good way to get fired, by the way. The reporting of all information, relevancy, I suppose, full disclosure, reporting of all information. The practice of preparing financial statements, periodicity, the quality of information that indicates the information made. Now, I think this is relevancy. Belief that items should be reported on the balance sheet at the historical cost. A company's use of the same accounting principles means they're consistent, not comparable, consistent. Tracing accounting, this is not, what did they call this one? Not the going concern. I forget this one myself. We'll learn it together. I'll relearn it. Consistency. Economic entity. The desire to minimize, report only those things is the monetary unit assumption. What is the primary criterion by which accounting information can be judged? Usefulness for decision making. If we can count on this information to make useful, cogent decisions, then we've done our job. And now we're getting involved in IFRS, which means we're not getting involved. Don't worry about anything to do with international. You may have some homework questions on that you want to, at least grab the fruit, but they're not going to be on the test at all. And if one of those questions did slip through, I would give credit for it. Okay. Let me take a deep breath. With that in mind, anybody have any questions? Any thoughts, Daniel?
I have one more for you. Why does, you said that with historical cost of property, that doesn't change until the property gets sold.
Yes.
But you're paying your taxes, properties will have to be reevaluated.
Certainly. Let's say you sold that property. You paid $100,000 for it. You sold it for 10 million. You now owe taxes on $9,900,000. The person who bought it from you, now it's his historical cost is the 10 million.
Okay.
Yeah, you see how that works?
Yeah, I do.
Yeah. But let me point something out. You can still go to a bank and the bank will say, well, your equity is only $200,000. Why should I loan you $1 million? And you say, look what I've got here. I've got the appraisal on this land that I'm sitting on worth $20 million. The bank will certainly take that into consideration, even though it's not part of your financial world.
Yeah.
Okay.
That's more what I was asking. Thank you.
Yeah. Okay. I guess we'll call it a class then. Okay, guys. Is that all right, Daniel?
Yep. Thank you.
Okay, take care, everybody. See you next week.
Thank you.
Bye-bye.
Thank you. Thank you.
Hey, Ho Chang, you
Yeah.
better go back to bed. It's 4 a.m. where you are, isn't it?
Yeah, I fall ill in the morning, so I cannot join the Zoom. Sorry.
That's okay. This will be, you'll get, a copy of this will go up on Canvas for you to look at if you wanted to see the presentation, okay?
Okay, sure. Thanks.
Tk you. See you
Thank
all.
you.
Bye-bye.
I have a
See you.
question
Have a
for
good weekend.
You too.
I have a question for you, Professor Smigula.
Milena, did you say you want to ask me something?
Yeah, I was just wondering.
Could you speak up? I can barely hear you.
Oh, sorry. Can you hear me now?
Go ahead.
I was just wondering, I know that the Zooms are at 1, and usually I have my work schedule is from 2 to 10.
Uh-huh.
I was just wondering if it's okay if I can attend the Zoom until like 1:40, and then if that could still qualify me for extra credit, or if I have to attend the Zoom for the full lecture.
Yeah, that certainly would be okay.
Okay, thank you so much.
That wouldn't be a problem at all. We work with you in college, right?
Right.
Okay.
All right,
Take
thank
it
you
easy.
so much. Have a good one.
Bye-bye, Thomas.
Thanks, Bob. Have a good one.